S&P 500 up 12 straight days, oil up $25, nobody blinked. Treasury yields up 25 basis points. Gas up $1. Markets cheer. Either the market knows something we don't, or it's completely delusional. I've read the data. Both can't be right at the same time. Someone is wrong. Badly wrong. And the bill always arrives eventually. 12 consecutive up days. That last happened in February before the crisis. The market acts like nothing happened. Ships blocked, energy disrupted, nothing. Short term, markets look drunk. 6 months later, they look like geniuses. That's why I don't trade noise. I hold positions and sleep well. The biggest rallies in history happened inside brutal bear markets. October 1987, market down 23% in a single day. That same September had more up days than down days. Think about that. Violent rallies fool investors into thinking the crash is over. That's where most people get destroyed. The false recovery kills portfolios. Market memory lasts 6 months. After that, it forgets the trauma. After a big shock, volatility clusters. Both up and down, wildly. This is not genius. This is physics. A compressed spring releases both ways. Semiconductors led this entire rally. Taiwan's market cap now beats the UK. Samsung, SK Hynix, TSMC, combined bigger than an entire G7 economy. The market says, AI fixes everything. Energy crisis, not our problem. 60 to 70% of trades are made by machines now, not humans. Algorithms buy when it goes up, sell when it falls. That's the entire logic. Add passive indexing on top. Now movements self-amplify with no human check. Short sellers see oil rising and bet against stocks. Then they get crushed. The market is not rational right now. It is a compressed spring, loaded and waiting. Two camps have formed. Camp 1, AI solves everything, buy semiconductors. Camp 2, energy crisis is building, this rally is a trap, protect yourself. Semiconductors are cyclical. They rise hard and crash just as hard. Pig cycle. Not enough chips, prices explode. Too many chips, prices collapse. AI is capital intensive in a way the internet never was. The bill will arrive. Internet companies needed almost no capital. AI needs enormous data centers. You need electricity. Massive, constant, cheap electricity. Near energy sources. If energy is disrupted, the AI build-out stalls. The entire thesis falls apart. Some major data center projects in Texas are already failing to raise capital. Even a Swedish battery giant collapsed because it couldn't raise the capital. Capital-intensive projects need years of negative cash flow before any return. Nuclear plants take 10 years to build, 70 years to generate returns. Most investors can't think past the next quarter. That's the entire problem. Real wealth is built by thinking in decades, not quarters. Always has been. The money printer is not savings. Real savings is deferred human labor. Period. Savings is paying someone to work today for a payoff years from now. Governments have redirected savings into transfers. Not capital, not growth. When savings funds transfers, your standard of living drops. No exception. China figured this out. They convert savings into capital better than anyone. And soon I'm going to show you exactly where this savings failure is leading us. But first, let's look at how the market machine actually works under the hood. 90% of you aren't subscribed. Hit subscribe and drop a thumbs up. It helps more than you think. Here's what most people miss about how markets actually move right now. Passive indexing means your dollars automatically flow to the biggest stocks. The bigger a stock gets, the more index money pours into it. No human decides. AI algorithms run momentum strategies on top. If it rises, buy more. Always. These two forces combined create self-reinforcing rallies that ignore fundamentals. Your income is not your wealth. Your savings rate is. Most people have it backwards. Foreign investors hold $9.5 trillion in U.S. Treasury bonds, plus $3.5 trillion in U.S. corporate bonds. The world is dollar-trapped. $13 trillion in U.S. paper, held by people who are starting to question why. For decades, you needed dollars to buy oil. That deal is quietly unraveling. When the petrodollar weakens, $13 trillion searches for a new home. Meet Marcus and Claire. Same salary, same age, completely different strategies. Marcus poured everything into semiconductor ETFs, rode the AI wave perfectly. Claire held gold, energy ETFs, Asian equities, Japanese bonds, slower gains. In month 1, Marcus is up 30%, Claire is up 8%. Everyone at Marcus's office thinks he's a genius. He believes it too. But semiconductors are a pig cycle. Boom and bust, relentlessly, every cycle. Energy crisis or not, people still need to eat, heat their homes, run their cars. Gold is up because real assets outperform paper when trust in contracts erodes. Turkish portfolio logic. When contract trust dies, own real things, not promises. Some investors are quietly rotating from bonds to stocks for exactly this reason. Bonds at current prices are not attractive enough to buy back from equities. When stocks dip, there's no alternative. So you buy more stocks on dips? The best investment account is not the one with the highest return. It's the one you actually fund. Abu Dhabi has $2 trillion in reserves and asked the US for swap lines. Why ask for liquidity when you have $2 trillion? Illiquid assets. That's why. A liquidity crisis can hit anyone, even the world's wealthiest sovereign funds. The dollar's dominance is fading. China and Japan now offer alternative swap lines. Diversification is not about owning more, it is about owning less of the wrong things. Swiss franc sounds safe, but adjusted for rate differentials, it often underperforms. If sterling yields 5% and franc yields 0, sterling only needs to hold. Currencies of commodity exporters, Canadian dollar, Australian dollar, are undervalued. Gaining exposure to commodities through their currencies is smarter than futures. Coming up, the single most counterintuitive data point in this entire market. Stay with me. Here is the reversal nobody wants to talk about. It isn't about semiconductors at all. The real wealth killer is governments consuming savings instead of converting them to capital. You can print all the money you want. If capital stock doesn't grow, living standards fall. China converts savings to capital better than any Western economy. That's their edge. Compound capital is not a number. It is a boulder rolling downhill, slow, then unstoppable. China started investing in nuclear energy in 2008. Those plants are coming online now. Nuclear plants generate negative cash flow for 10 years. Then cash flow turns massively positive. When China's cash flow turns positive, that's when its stock market will really surge. China also stockpiled strategic reserves after 2008. Oil, gas, food, rare materials. That's antifragility. Every crisis makes you stronger because you prepared for it. Western economies chose efficiency over resilience. Now they are paying that price. Ricardo's comparative advantage theory only works when supply chains never break. Ukraine proved it. Iran proved it. Energy sovereignty is non-negotiable from here. Electrification requires massive capital. Nuclear, solar, wind, geothermal, all of it. European electricity pricing rules punish countries that invest. That's not working. Modern supply routes by sea are vulnerable. Future infrastructure must go overland. Railways, roads, overland freight corridors. The next infrastructure mega investment cycle. The Hang Seng fell after September because confidence requires a new China-US deal. The Chinese market rose 25% in 1 year, entirely in the first 6 months. Patient capital wins. You don't need to time China. You need to understand it. The Brazilian real rate is 7 to 8% above inflation. That is genuinely attractive. Latin American rate normalization could be the same trade Europe had in 1981. When structural rate declines happen, bond markets generate enormous capital gains. Meanwhile, Marcus's semiconductor ETF just corrected 15% on supply glut fears. Claire's diversified portfolio is down only 2%. Gold offset everything. Portfolio construction determines outcomes more than stock picking ever will. Bank of France repatriated gold to generate a €13 billion accounting gain. Central banks lending at negative rates to prop up commercial banks destroy their own balance sheets. Gold repatriation masked those losses. The balance sheet would have been negative without it. The real story isn't where markets are now, it's where savings flows will force them to go next. Here is the complete defensive portfolio built for exactly this environment. 4 assets, 1 logic. Gold is your anti-fragility anchor. If OECD debt implodes, gold surges. Period. Energy ETFs capture the upside if the crisis deepens and energy prices stay elevated. If energy prices fall instead, Asia benefits enormously. Your Asia ETF offsets the loss. Japanese bonds hedge against deflation. They provide stability when everything else moves. Each scenario this portfolio faces has a winning asset. That is the entire point. This is not random. Each holding earns its place by protecting against a specific catastrophe. Do not chase energy ETFs after they have already risen significantly. Wait for the dip. Keep cash reserves to deploy when asset prices correct. Opportunity requires dry powder. Compound capital is a boulder rolling downhill. Your job is just to keep it rolling. Do not let compliance bureaucracy, fund complexity, or market noise stop you from starting. Individual stock picking within your 25% allocation? Entirely your call. Hydrogen ETFs, coal miners, junior miners, only pursue them if you do deep research. Worry about returns. But not getting destroyed matters far more than optimizing gains. A 30% loss requires a 43% gain just to break even. Math is merciless. That's why Claire's portfolio, up only 8%, beats Marcus after the correction. Avoiding unnecessary losses is the single most underrated wealth-building skill you can develop. The Latin American opportunity: buy while governance is poor, benefit when it normalizes. Brazil's real yields of 7 to 8% are already paying you to wait for the turn. Most people invest for performance. The real wealth builder invests for survival first, performance second. Think of the Canadian dollar as a cheap call option on global commodity demand. Canada has oil, water, food, and land. Undervalued currency, underappreciated resilience. If you worry about extreme scenarios, holding physical Swiss franc notes is not unreasonable. But adjusted for zero interest rates, franc outperformance almost entirely disappears over time. ETF sanction risk is real but manageable. Hold through a Swiss-based or neutral custodian. If sanctions hit Asia anyway, gold and Japanese bonds surge. Your portfolio self-hedges. Commodities are hard to own directly. Own the currencies of countries that export them. Complexity kills retail investors. Simplicity, held consistently, wins over decades. The short-term market remains incomprehensible. Do not trade it. Position for the next year. The real game is not beating the market next month. It is still being in the game in 10 years. Energy markets will show real stress in weeks, not months, as blocked ships clear out. Historically, markets price in energy crises only when queues form at petrol stations. That lag is your window to position before the market catches up. We are inside that window now. Do not buy if you need the money in under 3 years. This is a long-duration strategy. Automate your portfolio rebalancing. Set it quarterly. Do not check prices daily. When energy corrects and Asia rallies, rebalance, trim Asia gains, add back to energy. Rebalancing forces you to sell high and buy low automatically. That is its real power. Now Marcus has lost 30% from his semiconductor peak. He is frozen, no plan. Claire rebalanced twice during his run-up. She never panicked. Her wealth kept compounding. Consistent process matters more than spectacular insight. Most people have it exactly backwards. The boulder from Act 3 is rolling now. Do not stop it by panicking and selling. Every market downturn that sends the unprepared running is a buying opportunity for you. 3 years later, Claire's portfolio is up 41%. Marcus is still recovering his losses. Same salary, same starting point. Completely different financial destinies. System beats genius. Claire's portfolio is the boulder rolling downhill. Unstoppable, compounding, and completely boring to watch. The market will keep providing opportunities. Ukraine, Iran, the next thing we haven't imagined yet. Anti-fragility is not pessimism. It is the most optimistic thing you can build for yourself. I hold the same 4 assets. I read the boring documents so I understand the real picture, The market is not your enemy. It is the best wealth creation tool in history when respected. Read the SEC filings. Read the Federal Reserve data. Know what you own and why. Stop trading noise. Start owning positions. The difference is compound interest over time. The S&P 500 posted 12 straight-up days while oil rose $25. It will resolve. Markets can look drunk for months. They always resolve toward fundamentals. That is the only certainty. Every week, I decode one real financial market document so you understand what the institutions know. If this changed how you think, subscribe and leave a thumbs up.